If there is one mistake that keeps traders stuck year after year, it is overcomplication. Too many indicators, too many opinions, too many strategies. The market does not reward complexity. It rewards clarity. What I'm going to show you in this video is a simple trading framework built around how price actually moves. No indicators, no signals, no guessing. Just structure, pullbacks, and mathematics. This approach works across Forex, indices, stocks, and even crypto because it is based on behavior, not indicators. If you understand one thing about markets, let it be this. Price does not move in straight lines. It moves in legs, impulse, pullback, continuation. Over and over again. Once you accept that, trading becomes much simpler. The first step is identifying whether the market is trending or not. This does not require advanced analysis. A trend is confirmed when price breaks a previous high and continues forward. That is it. You have a starting point. Price moves up, pulls back, then breaks above the previous high. At that moment, the market has shown intent. Buyers are in control. Once that happens, your job is not to chase price. Your job is to wait for the pullback. Most people hear buy the dip, and they think that means buying randomly when price drops. That is not trading. That is hope. A pullback must occur within a valid leg of the trend. You are not buying weakness. You are buying continuation after a correction. Every trend has a leg. That leg has a high and a low. Between those 2 points, price has mathematically relevant zones where reactions are more likely to occur. The most important zone is the equilibrium, the midpoint of the leg. When price pulls back toward the middle of a move, that is where probability begins to favor continuation. Deeper pullbacks offer better risk to reward, but they happen less frequently. Shallow pullbacks happen more often but offer less reward. Both can be traded, but the rules must stay the same. Your objective is simple. Enter as far back as possible in the pullback while staying aligned with the trend. This is where structure and so-called order blocks come in. These are areas where price paused or consolidated before moving aggressively in one direction. That pause tells you there were orders left behind. When price returns to those areas, it often reacts again. You do not need to label them with fancy names. Call them demand, supply, order blocks, points of interest. It does not matter. What matters is that price reacted strongly from there before. Those areas are where you want to be involved. The deeper the pullback into a valid zone, the better the mathematical opportunity. Why? Because your stop loss can be tight and your target remains the same. This is where most traders misunderstand win rate. You do not need to win most of your trades. You need your winners to be larger than your losers. If you risk 1 unit to make 4, 5, or 6 units, you can be wrong often and still grow your account. This is not theory, this is mathematics. Let's say you risk 1 unit per trade. If you lose 1. If you win, you make 5. Even with a 40 to 50% win rate, you are profitable over time. That is why pullback trading works so well. It naturally creates high reward relative to risk. The stop loss is placed beyond the zone that invalidates the idea. If price breaks through it cleanly, you are wrong. You exit without emotion. The take profit is placed at logical structure. The previous high in an uptrend, the previous low in a downtrend. You do not get greedy. You take what the market offers. Another important rule is leg management. Once price makes a new high and starts pulling back again, the previous leg is finished. You do not trade old zones anymore. You focus only on the new leg. This keeps your analysis clean and prevents overtrading. Most losing traders are reacting to old information. Professionals adapt to new structure. This entire framework is about alignment. You align with trend. You align with pullbacks. You align with probability. You are not trying to be right. You are trying to be consistent. Now here is something that matters more than most people realize: execution. Even the best strategy fails if you trade with poor execution. Slow platforms, wide spreads, slippage, these things destroy edge over time. That is why broker choice matters. If you are serious about trading this strategy, you need a broker that gives you fast execution, tight spreads, and stable trading conditions. That is exactly why we recommend the brokers linked below. They offer professional trading environments and exclusive bonuses up to 2 on your first deposit. Available only through our links. This matters because starting with additional trading capital gives you more flexibility in risk management and trade execution. If you are trading from the United States, you need a platform that actually supports US clients. If you are outside the US, you want access to deep liquidity and low-cost trading. Choose the right tool for your location. It makes a real difference. At the end of the day, trading does not need to be complicated. It needs to be disciplined. Trend first, pullback second, risk management always. Repeat the same process again and again. That is how traders survive long term. And that is how accounts grow.